You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined by my co-host, John McEwen. It is the 7th of August, 2022. And in this week's episode, we'll be discussing Rightmove, primary health properties, ITV, British American Tobacco, Nestle, and Apple. So, John, should we start off with a favourite of the show, Rightmove?
Yes, and one with both shareholders in.
Rightmove have come out with their half-year results, and revenue was up 9% to 162.7 million. Operating profit was up 6% to 121.3 million, and that gives it an operating margin of 74.6%. Underlying operating profit was up 5% to 122.4 million. Interim dividend was up 10% to 3.3p a share, and basic earnings per share was up 8% to 11.7p a share. In terms of the operational highlights, they've said time on the site averaged 1.5 billion minutes per month over the period, and that compares to 1.7 billion a year ago and 1.1 billion pre-pandemic, so it's 30% higher than the pre-pandemic record. The average revenue per advertiser was up 11% to £1,290 a month, and that's up from £1,163 a year ago. There was record agency average revenue per advertiser growth, which was up 12% to £132 a month, and strong average revenue per advertiser growth in the new home sector, which was up 9% a month to £117 per advertiser. And that was driven primarily by the increased product purchases and package prices. There's been stable overall membership numbers since the start of the year at 18,934, with 16,116 agency branches and 2,818 new home developments. And that compares to 16,110, so 6 lower at 31 December, and 2,859. So the new homes has dropped slightly. They've said the strong housing market, combined with Rightmove's market-leading position, led to the highest net growth in sales agent branches since June 2016, offset by a reduction in lettings-only branches. They've also announced the initial release of their Lead to Keys tenant digital workflow, a market first as part of the digitisation of the rental journey. There were a couple of points in the slides as well. So first one was the referencing market. So they've only got 10% market share in that at the minute, and that's up from just over 8% in June 2019. And that's partly due to a 9% increase year over year in additional revenue per reference. And they said they've got scope to increase the attachment and renewal rates. And they also showed a graph of the housing transactions for the half. For this half, it was 582,000, and that compares to 824,000 a year ago, 405,000 the year before that, and 541,000 pre-pandemic. So I think it's actually quite interesting in that housing transactions has fallen off a cliff, really, from 824,000 to 582,000. But because they're just getting the money from the advertisers, their revenue's up 9%. They've not felt that drop really at all. In terms of the valuation, the business trades at a PE of 29. My view is these are excellent results. You wouldn't know we're in a recession from these results. It's quite pricey, but I think in this market, you can understand why it's trading at a premium given how good of a business it is. As a shareholder, I don't think I'll be adding at these prices, but I certainly won't be selling. What are your thoughts, John?
Pretty similar, really. And I think it's that operating margin. It effectively has a monopoly in the rental and the sales market as the property portal to go to. I was going to ask, I mean, we both like it. Is there anything that worries you about it as a stock? If we were going to play devil's advocate with it,
I guess it would be the valuation, because you're paying 29 times earnings for a business that's growing revenue 9% a year. I would argue it deserves a premium for being a monopoly because those earnings are a lot safer. But if it's going to grow at 9% a year, the share price could not move for a few years and still be quite expensive. So that's a concern. What else? I guess the new homes, we have seen a drop off in that recently, just because the developers can't sell them quick enough. They don't really need Rightmove.
Yeah.
And if if that situation continues, that's probably going to impact growth. I mean, we've looked at purple bricks and we've looked at on the market, and neither of those particularly worried me. I'm not really worried about the competition. I guess for me, the main issue would be valuation. What about you?
Probably the same. There are a few downsides that I see to it at the moment. I suppose a really severe recession would be something, and then that's inevitably is going to feed through. But I know I really do like it as a company, and happy just holding it and not looking at it, and hopefully come back in 10 years and see where we are.
Yeah, I do actually think though they should buy Spare Room. Yeah,
it would make a lot of sense. Is Spare Room independent? Is it private company?
So I think I had a look at one point, but I'll just Google it. I think it's private. So it's talking about the story on the website. It's found brainchild of Rupert Hunt. So let's see. As we say, he set up in 2004. It's been around a while. But today, it's the UK's #1 flat sharing website. Over 2 million visitors every day. So it's in the basically the story section of the web, and there's nothing talking about a sale. So I think it's private. In fact, let's see what it says at the bottom of the website. I might have the company name.
Flatshare Limited.
If we go on to Company's House, let's have a look. Bit of a tangent, but all right, Flatshare Limited. Let's have a look in the filing history. Ooh, let's have a look at the accounts actually and see what the turnover is on it. It might not be worth them getting. Well, I think they could do a lot more with it.
Yeah.
So I don't know actually. So turnover, the last accounts on Company's House was the year ended 31 December 2020. Turnover was 10 million. Cost of sales 4.8 million. So it's only got a gross profit margin of 5.2 million. A gross profit of 5.2 million. So that's about 52%. I think Rightmove could get that a lot higher. I don't see any reason why. And the operating profit's only like a 24% operating profit margin. I don't know the business as well as they do, but I think Rightmove could get that operating margin a lot higher. But for the half, Rightmove have revenue of 162 million. So it would add about 5 million of revenue. So it wouldn't be tiny. And like I say, I think they could do a lot more with it. But it's probably not going to cost them a huge amount either. They could just buy it with the cash they've got.
Yeah.
Anyway, let's see who owns it as well. Let's have a look at persons with significant control. The Rupert Hunt, it looks like he owns 100%. So it's on Company's House. He owns over 75% of the shares. I think they need to make Mr. Hunt an offer. I really do. Because I can't imagine, like, whatever price he wants, they'd be able to pay it.
Yeah.
And you could let him carry on running it as well. We should raise that at the AGM.
Yeah. We'll turn up.
Right. Yeah.
When is it?
I don't know. Well, these are the interim results. It's not going to be for a while. It's probably going to be about 6 months' time, isn't it?
So, fine, okay.
But I genuinely, I think that's not a terrible idea. I think it would make a lot of sense, and I think it's absolutely very doable. So we will send them an email, or if one of the listeners wants to do it, another listener that owns shares and wants to take the credit, we'd be more than happy for you to do that if it saves us typing out an email, and they could appoint us as like advisors, strategy advisors. Right. Okay, shall we get back on track?
Yeah. Okay. So on to another, different type of property company, but Primary Health Properties, which is a FTSE 250 listed healthcare REIT, so real estate investment trust. We've covered it before on the show. It basically specializes in GP surgeries, sort of often bigger GP surgeries, which might have physios and pharmacies in them too. They had their half-year results out last week with net rental income up 5% to £71.1 million and underlying profits before tax up 9.8% to £44.7 million after upward rent reviews and savings made as a result of debt refinancing. The value of the property portfolio rose from £2.8 billion to £2.9 billion, and annualised contracted rental income rose 2.5% to £144.2 million, compared with December 2021, largely as a result of the rent reviews and acquisition of the Chiswick and Chertsey medical centres. Occupancy came in at 99.7%, and the weighted average unexpired lease term was just under 11 and a half years. The group's current acquisition pipeline is in the region of £285 million, which includes projects in the UK and Ireland, with nearly 60% of those at an advanced stage. The group's expecting to invest a further £52 million into developing these properties and hopes this will add around £1.6 million to annual rental income and extend the leases in those properties to around 20 years. Net debt was up by £170 million and now stands at £1.3 billion, whilst the loan to value ratio measuring the leverage grew from 42.9% to 43.1%, which is within management's target of between 40 and 50%. In terms of valuation, Primary Health Properties has a market cap of £1.9 billion and trades at 13 times earnings with a price to book of just over 2 and a prospective dividend yield of nearly 5%, which represents 26 years of consecutive dividend increases. I do like Primary Health Properties, certainly not the sexiest stock, but it's probably one of the most defensive, certainly in the real estate investment area on the UK market. And it should develop a good or a decent return, regardless of the economic situation, with nearly 90% of its rent coming from the NHS. So it's almost sort of guilt-like in that sense. Concerns I've had in the past with it, it's certainly when we had Jeremy Corbyn as leader of the Labour Party, this was sort of a right target for, I suppose, the private sector in the NHS, and it's something that had been touted to be nationalised under a Corbyn government. The politics have moved on significantly since then, but that is something that would always be a risk. And then you don't necessarily know what health spending is going to be and what form primary care or GP surgery is going to take in the future. But I think it's compared with a lot of other real estate investment trusts, it's very secure. With the company in particular, though, it does have quite a lot of debt on the balance sheet, and that would be a concern. And I don't think you're ever going, it's not an exciting company where you're going to see huge or unlikely to see huge growth. But then again, it's not that highly rated. Price to book is a bit higher, but it's not priced for massive growth. So as an income part of the portfolio, there are certainly worse options. Don't think it's for me, but it's certainly one that I'd enjoy watching and reading about and seeing how it does. Sam, what are your thoughts on it?
Pretty similar. I agree straight away. It's just not for me, just because I'm not, just the lack of growth prospects. But that dividend yield is very good. The occupancy is fantastic at 99.7%. Yeah. It's not going to drop, or it's very unlikely to drop. I wouldn't be concerned about the debt just because you've got the properties. It's backed up by the properties. And I think, to be honest, the value of the properties, it probably sets a bit of a floor on the price. And it's, if it fell to below the value of the properties, and that's not really, as a shareholder, you can just buy more. It's not really a terrible thing for you. But I think for such political concerns aside, for such a secure source of rent, probably relatively inflation proof, in that even if they can't raise the rents because the NHS salaries are only going up so much, you will get the increase in the values of the properties. So you're always going to get some benefit from the inflation. Yeah. I think 13 times earnings is pretty reasonable. I think if I was more of an income investor, I would possibly take more of a look at it, but I don't see a huge amount of growth.
Yeah. And I think the other thing is, you point to the occupancy being 99.7%. It's also, I think that's very unlikely to change, because certainly new GPs today aren't going to want to go out and take big loans to build purpose-built premises for their surgeries themselves. I think it's much more attractive or much more realistic for them to go out and just sign up to a lease in a nice new building that is owned by Primary Health Properties.
Yeah, no, I think it looks like a pretty decent company.
Yeah,
fine. As long as it's not nationalised.
Well, but seriously, I mean, that was a very real risk a few years ago. So the whole model.
But they wouldn't just take it off you, would they? They'd give you you're probably going to get at least Like, I don't think they wouldn't take it off you in this country. Maybe if it was like,
I
mean,
don't
whereas with
know.
Airtel Africa, that is a real concern.
Yeah, I don't know. I think, yeah, I can't imagine John McDonnell would have given you the price that if you were a shareholder, you'd have expected.
I think you'd at least get the trading price when it's announced. I don't think they do
Yeah.
it below the market value.
Yeah. Anyway,
yeah,
it's all
just pure speculation.
So we're gonna move on to ITV.
Yeah, ITV. So I'm sure we're all familiar. Anyone with a television will be familiar with ITV. So they have come out with their first half results, and first half underlying revenue rose 8% to 1.7 billion, reflecting better than expected growth across ITV studios and media and entertainment. Increased revenue was offset by increased investment in the new streaming project ITVX. Underlying pre-tax profit was flat at 301 million. ITV is mindful of macroeconomic and geopolitical uncertainty and expects total advertising revenue to fall 9% in July and 18% in August compared to the previous year. This is broadly in line with expectations and partly reflects tough comparisons with last year when the group broadcast the Euros. If we break those results down a bit more, media and entertainment, which includes the group's streaming and traditional broadcast business, saw revenue rise 4%. That included a 5% increase in ad revenue to 910 million, while non-ad revenue dipped 4%. Advertising revenue was driven by digital advertising, with revenues here up 20%. ITV Hub streaming was up 8%. Underlying operating profit fell 16% to 194 million as content spending rose 58 million and data and technology investment increased by 20 million. Within ITV Studios, revenue was up 16% to 927 million, with high-end scripted hours up 82%, with revenue from streaming platforms now making up 19% of total divisional revenue. Cost savings meant underlying operating profit rose 31% to 124 million as the group looks to offset higher COVID-related health and safety costs by trimming its property portfolio and digitising its processes. ITV is on track to exceed 2019 revenues over the full year. Free cash flow after payments for interest, cash tax and pension funding was a deficit of 11 million compared to an inflow of 71 million last year. The difference mostly reflected increased pension funding, including a one-off payment of 80 million on the extension of the SDN pension funding partnership. Group net debt was 615 million as at the end of June, up from 467 million a year earlier. ITV said it's well within the agreed terms set by its lenders. In terms of the valuation, there's no dividend, and the business trades at a forward PE ratio of 5.9, and that compares to a 10-year average of 11.3. I thought that all things considered, these were a fairly decent set of results. I think the upcoming drop-off in advertising revenue is to be expected just with a recession and tough comparatives. The only thing that I'm not sure on is, although the streaming platforms making up 19% of revenue is good, I just don't really feel like I know what their streaming strategy actually is, and I'm not sure what they do, because this is like, I mean, this is the first time I've heard of ITVX. I know they've got the ITV Hub, and that's where you can watch like anything, like, I might be wrong, but like the last 30 days, say, for free, and they just hit you with about 2 hours of adverts for every 20 minutes of TV. So that'll be where that revenue is coming from. And then I'm also aware of BritBox, which is joint with Channel 4 and BBC, and they're getting a share of that. But I hadn't heard of this ITVX before, so I had a look at that. And it says ITVX is the new streaming home of all ITV and so much more, with exclusive new series launching every week. An ever-changing library of blockbuster movies and the nation's biggest live events, curated themes and theme channels, thousands of box sets, and the ability to access BritBox on all in one place. I mean, they've got ITV Hub now, they've got their share of BritBox, and they've got ITVX. I don't really feel like there's a clear strategy here. I just don't understand it. And I don't think they're going to be able to compete with like Netflix in terms of content. I don't think they're going to get that many people signing up either. Maybe you'll get a few people in America signing up where it's like they can't watch it on TV. So if they like certain shows or some of the older shows, they might do it. But I can't think of a single person I know where I'm like, they'll probably sign up for ITVX. Like, genuinely not one. If I think of and not that I know a huge amount of people at my age that will watch ITV, but if I think of like my grandparents who do, They'll just watch it on the telly, or they'll watch it on ITV Hub if they're technologically able, but they're never going to get ITVX.
Or
So
they might just not watch it.
yeah, or they'll not
But
watch it. But
yeah,
I just think the streaming, it doesn't seem like they have a clear strategy, but maybe that's partly why it's so cheap. But I think for the price it's trading at, these are fairly decent results. What are your thoughts, John?
I mean, yeah, I think it comes down to the price they're trading at, really. But I think, like you, I'm not sure what the long-term vision is for ITV. Content is expensive, and you see that particularly with Netflix and the amount it's having to spend to have the great content that it does. And it's very cyclical, and it looks like we're going into an economic downturn. So I can't see in the short term things getting any better for ITV. It's not one that I'd probably like anyway, but I definitely don't like it at the moment.
No, I wouldn't be interested in it, but I think, I don't know. I think, 5.9 times earnings, there might be some value there. It's just not my style of investing.
Yeah, it's definitely a value play, if anything.
Yeah. Right. Shall we move on to another value play?
We should move on to another value play. So British American Tobacco, which is the UK's largest tobacco company, listed on the FTSE 100. They had their half-year results out last week, with first half revenue up 3.7% to £12.9 billion, with the strong performance of non-combustibles. Underlying operating profit rose 4.9% to £5.5 billion as the losses from non-combustibles narrowed. In terms of the non-combustibles or new category, revenue increased across all product ranges and total sales grew 45.4% to £1.3 billion. Traditional combustibles, which include regular cigarettes, saw sales rise 0.6%, with price rises offsetting volumes, which were down 4.2%. Geographically, the US saw revenue broadly flat, with a growth in non-combustibles offsetting the declines in combustibles, where volumes of combustibles fell 13.4%. The Vuse e-cigarette was the standout performer as the market leader in the US and delivered revenue growth of 60%. Operating profit was up 5.5% to £2.9 billion. In Asia Pacific and the Middle East, revenue was up 4.7% to £2.2 billion, with volumes of combustibles increasing and volumes of combustibles also doing well. Heated tobacco was the standout performer and sales rose 15.6%, with Glow being particularly popular in Japan. And that's a sort of heat not burn, vaporizing fine tobacco type product. Operating profit, however, fell 5.4% to £821 million, with a higher proportion of sales coming from these lower margin products. In the Americas and Sub-Saharan Africa, revenue was up 6% to £1.9 billion, with growth in non-combustibles and traditional combustibles. Operating profit was up by 6.5% to £754 million. In Europe, revenues were up 9.7% to £3 billion, and operating profit was up 11.7% to £997 million. The division was hit by the £957 million impairment charge as a result of the planned disposal of the Russian business. Free cash flow rose from £1.3 billion to £2.3 billion, with the increase in operating cash flow, and net debt fell from £41.3 billion to £40.8 billion. Alongside the results, the group confirmed they were on track for the full year guidance, with constant currency revenue growth of between 2 to 4%. And they were progressing also towards the £5 billion in new category, which is non-combustible revenue, by 2025. In terms of valuation, British American Tobacco trades at 9 times forward earnings, compared with a 10-year average of 13, and currently yields a whopping 6.9%. Ethics aside, because obviously there are lots of ethical concerns with British American Tobacco and Imperial Brands, I thought these were very robust results, and they were particularly strong with those non-combustibles, basically e-cigarettes, or e-cigarettes certainly accounting for the most part of that, showing that probably, and this is coming onto the valuation, whether it's a value play or not, that perhaps it isn't the cigar butt. And that was pun intended, Sam. But it maybe it does have a future with those non-combustibles, even when people stop smoking. And I mean, you're seeing it particularly in the States, volumes being down nearly 14%. But there's that almost replacement with an e-cigarette, which is obviously less harmful, but still not harm-free. So it's certainly on paper, by sort of conventional valuation metrics, it looks cheap, but also it doesn't look like it's a company that's going bust anytime soon. And it's, as we're seeing, churning out a lot of cash. So yeah, it's an interesting one. What are your thoughts, Sam?
Over the last couple of years, I've been really impressed by the new categories. It's, you know, especially when, I mean, British American particularly, because when you look at Imperial brands, their new categories aren't doing nearly as well. But British American, their new categories, it's been growing at about 50% a year for a couple of years. I don't think the 5 billion revenue target's that outrageous. And if they carry on growing at the rate they are, I don't see why they can't get there. It's very anecdotal, but when I go on nights out, I will speak to people who are smoking the e-cigarettes, and like if you talk to girls smoking the e-cigs, like a lot of the time I'll ask them, like, did you smoke cigarettes before you started smoking that? And most of them say no. There's a lot of people I know where like they will go out and they will buy like one of the disposable e-cigarettes, like 300 or 600 puffs, just for that night out, like you would with like a couple of drinks. I know people who like have smoked cigarettes and now smoke the e-cigarettes, and they spend more money on the e-cigs than they did on cigarettes. Granted, this is when you compare it to like rolling your own cigs. Granted, the margins will not be as good, but regulation aside, I think, and that is a big caveat.
Absolutely.
Like you look around, it's just everywhere. Like the people who smoke them, and I don't think it's as well. It isn't as bad for you, but you find the people that smoke them, they tend to go through them very quickly because you can smoke them inside. And it doesn't really smell, so they can just churn through them. I know it's bad, but like, you know, the 18-year-old girls on a night out that maybe they aren't used to smoking, they wouldn't be able to smoke a cigarette without coughing. They can just buy a little strawberry cigarette and suck on that all night. I think, regulation aside, I think the future looks quite good, and British American is really, for a couple of years, less so now, it's gone up a bit, but it's not really priced like it's got much of a future. If you get a 7% dividend a year and the revenue that's being lost, and the revenue isn't being lost at the minute because they just keep increasing the prices on the combustibles anyway. But if that were to start dropping off and the e-cigs is replacing it, it's a bargain.
And they're also the number one e-cig in America. So the biggest market, and they've become the market leader, which, considering the competition they have, is quite remarkable.
And I don't think, I mean, this is just my personal opinion, so it's completely meaningless, but I don't think they should really be regulating them that heavily, because I think they're better for you than cigarettes. And I think, is it really that much worse than going out and having a few drinks? I think it's a very grey area. But if you compare that, like cigarettes are obviously just, or from what I understand, they're a lot worse.
Oh yeah. No, there's certainly no doubt that cigarettes are a lot worse. And I suppose there are a lot of sort of ethical issues that hinge on it, and whether some people see it as sort of either a gateway or less of a harm reduction, and maybe like those young people who are vaping
that would never have smoked.
They would, exactly. So whether you're getting those people into it, but then I guess with the long-term or potential long-term harms, we don't really know. It's something that's probably yet to be discovered. But the consensus seems to be a lot less harmful than smoking, but not harm-free. So it'll be very interesting to see how that trend develops. But certainly, British company, and it's got the number one e-cig brand in the States. Which,
if I was going for a tobacco stock, that would be my pick.
Yeah, it's and interestingly, they trade, in terms of valuation wise, they're a lot less than certainly Philip Morris in the States.
And it's not, I know it's a very slight premium to Imperial brands, but it's not that much of a premium, and I think it's a much better company.
Yeah. I mean, it certainly looks like it's better run, and geographically it's much more diverse too. And they've got, when it comes to the e-cigarettes, they are dominating.
Yeah, no, we always have to put the big caveat of ethics aside, but as a
Yeah.
business, I think there's a lot to like.
But the market, I mean, but that is something though, because in terms of the rating, those things, especially with ESG investing, they have, well, it's probably partly rated as it is because ESG and people who are investing with ESG in mind are clearly not buying British American shares.
But that's giving you a much higher yield. So what do you care if it's if anything, it's better?
It's more, I suppose it would be more if somebody bought it hoping that the share price was going to go up significantly in the near term.
Yeah, but yeah, I agree. But then if you're going to get a 7% dividend in basically perpetuity, and if the combustibles is replaced, that can be maintained in basically perpetuity.
Yeah,
it's a very good deal.
It's certainly, I think it's certainly a complex investment case. But anyway, let's move on to Nestle. Is it a healthy company, Sam?
Yes, it's a very healthy company. So all these figures are in Swiss francs. Nestle have come out with their half-year results and they've announced sales of 45.6 billion. Should I guess what this? In fact, I'll better get the exchange rate. Otherwise, it sounds massive. 45. I mean, it might be. Oh, actually,
it still is massive.
It's worth 86p, so it is pretty massive. I wasn't sure if it'd be like 30 to 1 or something. Right. So, okay. So it actually is pretty similar. But half year sales of 45.6 billion, reflecting 8.1% organic growth. Volumes and pricing contributed 1.7% and 6.5% respectively. Growth was broad-based across most geographies and categories. Underlying operating profit rose 6% to 7.7 billion, aided by higher sales as cost increases weighed on margins. Full year organic sales are expected to grow 7 to 8%, up from 5%. Underlying operating margin is now expected at around 17%, down from 17 to 17.5%. If we break the results down by region, North America posted sales of 12.1 billion, reflecting growth of 9.6%. Growth was entirely down to higher prices, which contributed 9.8% as volumes fell 0.2%. The zone saw continued broad-based market share gains, particularly in pet food, coffee and creamers, as well as premium water. Underlying operating profit rose from 2.1 billion to 2.3 billion. Europe saw sales growth of 7.1% to 9.3 billion. Volumes rose 2.1%, helped by a recovery in out-of-home channels, and price rises contributed 4.9%. The zone continued to see market share gains, particularly in pet food, coffee, and infant nutrition. Underlying operating profit fell from 1.7 billion to 1.6 billion as higher prices couldn't fully offset rising costs. Sales grew 8.2% in Asia, Pacific, and Africa to 9.3 billion. Prices rose 6.1% and volumes 2.1%, with broad-based contributions from all geographies and categories. Underlying operating profit was broadly flat at 2.2 billion as sales growth was offset by higher costs. Broad-based contributions across geographies and categories helped Latin America post sales growth of 13.6% to 5.7 billion. There was volume growth of 4.2% and price increases of 9.4%. Underlying operating profit rose from 1 billion to 1.2 billion. Greater China reported sales of 2.7 billion with growth of 2.3%. Whilst ongoing movement restrictions impacted trading, growth was supported by robust demand in e-commerce. Volumes grew 1.6% and prices 0.7%. Underlying operating profit rose from 352 million to 400 million. Nespresso posted sales of 3.2 billion with growth of 2.6%, entirely down to pricing, which contributed 4.2%. Nestle Health Sciences saw sales grow 6.6% to 3.2 billion. This was due to volume growth, which was up 4.4%. The Orgain acquisition, as well as brands from the Bountiful Company, helped sales increase 57.2%. Free cash flow decreased from 2.8 to 1.5 billion, which reflected a temporary increase in capital expenditure to meet strong demand. Net debt increased to 48.5 billion, up from 32.9 billion at the start of the year. That was largely as a result of the cash return to shareholders. So as the valuation, the business trades at a PE of 23.7, and that compares to a 10-year average of 21.1, and it has a prospective dividend yield of 2.6%. I thought these were fantastic results. Interestingly, for anyone listening last week, we covered Unilever and Reckitt, and we gave Unilever the benefit of the doubt for having volume drops because we put it down to a different product mix to Reckitt. I'd say Unilever's product mix is more in line with Nestle. So if Nestle have increased volumes, I would probably tweak what we said last week to say, actually, I don't see why Unilever couldn't have increased the volumes as well. I know every time we cover it, Nestle is probably a better run business anyway. I think it's an excellent company. I think it's got excellent brands. These are excellent results. It's a bit pricey for me, but the reason it trades at a premium to Unilever is because it is a better run business. John, what are your thoughts?
I mean, almost identical, mirroring it really. It is. They all consistently since starting the show, when we've covered Nestle, like you say, they've been better results. The brands I would say are similar. Obviously, Nestle has some very strong ones, and Nespresso at the top of them probably, but you do pay up for it. And it was 23 times earnings. Unilever is more like, well, just under 17. So I suppose that's what you get for the extra money. But hopefully, we're living in hope that Unilever is still being turned around now with Peltz on the board, and we'll have to see what happens with that and whether they can develop things further to produce results like that.
I didn't want to go back to Unilever because we did cover it last week. It's just that, so for me, these results do put Unilever's results in a slightly different light.
Yeah, that's right. But we were, impressed with how Unilever had done.
Oh yeah, they're the best set of results we've seen from Unilever in the last couple of years. But it shows there's still a way to go.
Yeah. What they could achieve.
Yeah. Shall we move on to another very good company?
Oh, yes. Okay. So Apple, US company of the week, and a company that I'm sure everybody is familiar with, maker of the iPhone and the Mac. They had their third quarter results out last week, with net sales rising 1.9% to $83 billion, with a small decline in product sales to $63.4 billion, offset by a 12.1% rise in services to $19.6 billion. Operating expenses were up 15.1% to $12.8 billion, with R&D exceeding $1 billion. Operating profit fell from $24.1 billion to $23.1 billion. And geographically, in the Americas, which is Apple's largest region, sales were up 4.5% to $37.5 billion. In Europe, sales increased from $18.9 billion to $19.3 billion. And in Greater China, sales were broadly flat and fell by around $1 billion in Japan. In the rest of Asia Pacific, sales rose 14% to $6.2 billion, and iPhone sales were up from $39.6 billion to $40.7 billion. Net debt stood at $60.5 billion, whilst the group generated free cash flow of $90.6 billion year to date. Apple has a market cap of just over $2.67 trillion, and it trades at 25 times earnings. And its average, or 10-year average, PE ratio is in the region of 16. I suppose it's difficult. I mean, I think in the where we are in the economic cycle, these were certainly very good results. And it's very encouraging to see services growing and certainly offsetting the hardware sales, which are the bulk of Apple at the moment. But I mean, I think the figures are really eye-watering in terms of the size of them. It's a huge company. I think it's difficult to predict how the next few years are going to be. Perhaps not as rosy as the last few years, and it's pricier than it has been over the last 10 years.
If you look at the business performance, I thought it was absolutely fantastic. I think they've done a really good job with services, and as well, to shift that volume of stuff.
Yeah,
with the supply chain as it is, you wouldn't know it. So I think the low growth almost, it doesn't give them enough credit, because just to maintain that scale must have been very, very difficult operationally. Well, I expect there's an element of if you've got an order from Apple, you're making sure that that's the one that's fulfilled because you don't want to lose that order. But even still, it's just absolutely phenomenal. As a business, I'm in awe of it. I think it's absolutely incredible. But would I pay 25 times earnings for a business that's growing sales 1.9%? I wouldn't. If it's going to grow at 2% a year, and I appreciate that a lot of, what would have been growth has just gone into maintaining sales probably because of the supply chain problems. But at 25 times earnings, 2% growth is just not good enough. It's got a long way to drop, I think, potentially. Or it could just not budge for years and years. But I wouldn't buy it for growth. And with a 0.61% dividend yield, I wouldn't buy it for income either, as wonderful as I think the business is.
Company of the week.
Probably go with British American Tobacco. I think ethics aside, I think that's the best price. It's the best business for the price, I think. What about you?
I'm a Rightmove shareholder and I would choose Rightmove again.
See, for me, it was just, I didn't feel like if I've sat there and said I wouldn't buy more at this price, I couldn't then say if I'm going to buy one this week, I'm going to go Rightmove. It'd just be,
I think, I didn't buy it at the current price, but in terms of the valuation, it was probably similar. So
I think we got it about 25 though.
Okay, well,
it's not a huge difference.
Well, it is, yeah. I'd have to go back and look, but yeah. Thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.